Hi, I'm Richard Vague with Tycos. Last week we posed the question, is Fed independence important? What would President Trump firing Jay Powell do to financial markets? Is compromised Fed independence a risk? This week we'll answer that question. Most of this concern about independence surrounds the issue of interest rates, and then the fear that if the Fed is not independent, the president will force the Fed to lower interest rates, which will bring roaring inflation. The thesis is that every president will find the temptation too great to resist. Let me remind you that interest rate management and inflation management were not even the reasons the Fed was created. Instead, it was primarily created as the lender of last resort in a crisis, which remains a pivotal and crucial duty of the Fed, along with acting as a repository for bank reserves as a forced measure of safety, and the new duty of issuing and supplying currency across the country, new in 1913, especially the currency-starved rural West. I would remind you that banks had previously been the primary issuers of currency, believe it or not. The Fed was also assigned the duties of doing things like helping settle transactions among banks, and it acquired the important duty of examining the safety and soundness of banks and approving banking powers and mergers. There was not a Fed funds rate or market, and the Fed managed rates in its early years by setting its discount rate, the rate at which banks could borrow from the Fed, which it would do within a fairly narrow 200 or 300 basis point range compared to the many hundred basis point range of today. And it started doing that almost immediately with the need to provide relief to banks with the onset of World War I. During that war, the Treasury began issuing Liberty bonds to help finance federal spending for military outlays, including outlays of U.S. allies. The Fed, believe it or not, took over the role of lead marketer for this government debt, offering lower interest rates for loans to member banks as long as the proceeds were used to purchase the Liberty bonds. By 1918, the Fed helped sell and collect nearly $17 billion in Liberty bonds to help finance war efforts. The first time that Fed independence became an issue was during the Korean War, when inflation roared, as it often does in wartime because of the shortages war induces, and the Fed moved to tame inflation by pushing the discount rate all the way from 1.5% to 2%, which it believed was the needed cure for that inflation, even though it's hard to believe that a measly increase of 50 basis points was up to that task. In any event, all that occurred under something called the Treasury Fed Accord of 1951, which established the idea and created the precedent for Fed independence. It became an issue of importance again with the famed dual mandate of 1977, which was a congressional mandate to maximize employment and create stable prices. And that all fed into the most storied moment in Fed history, the vaunted Paul Volcker interest rate increases to 20% of the late 1970s and early 1980s. These increases were celebrated as the cure for massive inflation, even though that inflation had primarily come from the punitive oil price increase engineered by the OPEC cartel, and the cure for that inflation was more related to the deregulation of oil prices beginning in 79 and resulting in a tripling, an increase in oil prices, which induced a tripling of drilling activity, but then led to a collapse of oil prices. In fact, the argument that lower interest rates bring inflation is not particularly strong, since low interest rates in both 2008 and 1990 did not bring high inflation, and very low rates in 1998 in Japan did not bring high inflation. In fact, they brought the very opposite. Nevertheless, markets believe lower interest rates will bring higher inflation and are rightly worried about the inflation tariffs will bring. So a perceived loss of Fed independence and a lowering of rates will very likely roil bond and stock markets in the U.S. and abroad. For that reason alone, the perception of Fed independence is important. But we believe in Fed independence for an additional, very different reason. Remember, the Fed examines banks for safety and soundness and approves mergers and the like. Can you imagine if the Fed, under pressure from the president, started doing these very things based on political motivations? We recently saw something along these lines when Senator Elizabeth Warren tried to influence energy lending policy through Fed examination policy. As her website said, quote, "It's clear that our entire financial system is in major danger from climate crisis, and yet neither the largest U.S. financial institutions nor the regulators that are supposed to hold them accountable have taken adequate steps to address Wall Street's role in exacerbating the crisis. In fact, many banks have actually increased their holdings of fossil fuel assets since the Paris Agreement was signed. By using the authorities Congress has already given them, federal regulators can mitigate the climate-related risk in our financial system and help accelerate the transition towards a clean energy economy," end quote. She's a senator, and she's trying to use the Fed to achieve what should properly be legislative aims. It's not hard to imagine a president doing the same thing, but even more boldly. President could block mergers, force divestitures, mandate credit policy, deny powers, impose punitive ratings or regulatory actions in order to achieve political aims. Remember, too, that the Fed is a bank that makes loans, though it has largely made those loans in the form of buying government bonds. Buying a bond is the equivalent of making a loan using a different structure. In the past couple of decades, the Fed has made or considered making other types of loans, including real estate loans in mass, corporate loans, auto loans, municipal loans, each in the form of bonds it has purchased. Can you imagine if a president got greater control of the Fed and could use it to make loans or not make loans to achieve its policy aims? With this power, it could make loans to his or her favorites and use that to get votes. That was the very reason that Thomas Jefferson so feared the creation of the first Bank of the United States, which was the nation's first central bank. And in fact, contemporaries believe that the first Bank of the United States used the threat of making or withholding loans to influence votes regarding such crucial legislative matters as the Jay Treaty and the quasi-war vote. A contemporary would protest that many were loath to vote against the wishes of Thomas Willing, the central bank president, for, quote, "dread of being refused loans at the bank," end quote. It was also part of the reason Andrew Jackson so loathed the second Bank of the United States and prevented its renewal. The $5.8 trillion Federal Reserve Bank could be used as an instrument of any number of presidential policies. If the president got his own choice as chair, which does happen, and made a few board appointments, which can happen, and massaged the legislation governing the Fed, something that Franklin D. Roosevelt did, by the way, to make the Fed of that day much less independent, well, you get the picture. If you don't think that risk is real, we invite you to consider the many new ways presidential power has been used over the last few months. Fed independence is important for far more than just interest rate policy. That's it for this week. Thanks.